This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Patrick, let's move on to talking charts in a chart deck that you have titled, wait for it, Talking Charts. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, you can just go to our homepage, macrovoices.com, click the red button that says Looking for the Downloads. Patrick, chart 2 here, S&P 500 continuous chart, and you got it, the gamma trampoline on the bottom.
Right. And so on the S&P 500 chart, I mean, the observation that has to be made is that we remain in bull trend. That 50-day moving average that is there is contained all the price action in that bullish upwards trajectory. But the one interesting part here is that the S&P is struggling to make 52-week highs. And the question really is that what will be the tailwind to drive higher prices? And that's where I want to take the conversation next few charts. But before we move on, I did want to highlight the gamma profile going in here to the tail end of the June expiry. And what we have is currently the gamma flip level lies about 41.68. Those are numbers provided by Spot Gamma, Brent over there. And the interesting part is that the last time we had that gamma flip, that was where we had a big spike in volatility. And today's lows, intraday lows, came in right around that level. So we're at an interesting moment where the market hasn't been willing to break out to new highs, and yet right below us lies the levels where we could see some volatility return. And so it'll be really interesting to see which way this market breaks in the coming while. My intuition as to which way it goes actually is a slightly bearish tilt to it, and I'll explain why here on the second chart. On page 3, we have the chart of the NASDAQ, and one of the things that is a part of my thesis right here is the fact that I don't believe that the market can make its next kind of 5% advance, a 200-300 S&P point advance higher without proper participation of the NASDAQ and the FANG stocks. The financials and the cyclicals have done so well for the markets and have been really where the leadership has been. But one of the interesting things is the NASDAQ is dogging it. When looking at this chart, it has failed to retest their highs, incredibly heavy, rolling over, and it gets worse if you look on page 4 when you actually target the actual FANG stocks. And you can observe that on the FANG stocks, the rally was just outright weak. And when you go to some of the individual components like Apple, Microsoft, and Amazon, they simply can't get any traction, or Tesla or Netflix. And we really are seeing these big market cap behemoths that simply can't get out of their own way. And the question really is can the S&P break out and make that next advance without this one important, very market cap heavy sector participating? And I personally feel that this is something that is actually giving some bearish tones to the marketplace, even though the S&P chart on the surface looks quite bullish.
Patrick, let's take a look at volatility in the stock market with the VIX on page 5. And boy, we're just coming off of what seems like, is that a multi-year low?
No, I mean, it's the post-COVID lows.
That's been more than a year now, buddy.
It has been more than a year. But I think the observation that I wanted to point out here along that key support line is that when we had that May spike in volatility that saw us shoot up towards 28 to 30 on the upside was the last time we had that gamma flip. So when we talked about it on the S&P chart on page 2, just really trying to identify what could arise if we just had any 50 to 100 S&P point correction kick in. It would certainly potentially have another proper spike of volatility into the mid-20s at minimum. And this is why it's such a critical moment, because the contracting volatility has actually been an important tailwind to the market up until now. Nonetheless, I wanted to move on to page 6 and just show that breakout candle on the dollar index that we talked about in the market wrap. And while one day never makes a new trend, and it's certainly we've had 2 false start breakouts on the dollar in the last couple of weeks, and each time the sellers came back pretty quickly, and the price action has been relatively weak. But I think that the support line that the multi-year support line on the dollar index we talked about even last week, I think on first test will hold. And so it would be very natural for the dollar index to bounce back toward 91 to 92. But the jury will still be out, even on a rally like that, whether that's enough to change the predominant bearish trend that's been so dominant for all of the last 6-7 months.
Well, Patrick, it'll be interesting to see how that plays out. Frankly, I think that the more that I hear of the bearish trend that's been dominant, what I hear is a lot of bearish rhetoric coming out of people who, in a lot of cases, are making arguments for why they think the currency should be weak on an absolute basis, but they're making a forecast that has to do with its outlook on a relative basis, relative to other currencies. And although I think the absolute outlook for the dollar is horribly bearish, I think it's completely jury's out on whether it's up or down for the dollar relative to the other currencies. It's competition between central bankers, and we don't know how it's going to play out yet. In any event, let's move on to crude oil, my favorite subject, on page 7.
Right. And this is where I wanted to just kind of observe some things beyond the fact that crude oil is breaking to a fresh high. So we clearly have a technical breakout to that 52-week high. And crude oil looks like at this point moving to $70 to $72 in the next week or two. It would be a very natural thing to occur. But what I find particularly interesting is if we go to page 9 and look at gasoline futures, we have not seen gasoline futures break to higher highs, and often we see the correlation between the two. Now, that doesn't have to always be the case. I mean, that's why crack spreads widen and narrow, but it will be really interesting to see whether other markets like this start to confirm the oil breakout or not, and this hasn't happened yet. Another really interesting thing about the crude oil breakout is that we're not really seeing it move the entire term structure, and this is where I wanted you to come in and give us some more context on this, but we continue to see all the longer dated crude oil contracts still trading in the mid 50s, and it really continues to just be a steepening of the backwardation in this curve that is being driven here. I mean, how steep can this curve get in your mind, Eric?
It can get steeper in my mind. We do have finally the Z1, Z2 spread, that is, or what some people call DIS-RED-DIS. The difference between the price of crude oil that is delivered in December of 21 and December of 22. The difference between those prices is back over $5 this week. It had been trading below that for the last couple of weeks in this consolidation. We're back above that. I think it goes considerably higher. Now, there have been times when the crude oil market has really seen substantial backwardation because usually of geopolitical stresses, where you get a difference between months where the average is more than $1 per month. So in other words, it would be $12 of difference between December of one year and December of the next year if the average difference is $1 per month of price. Right now, it's less than 50 cents on average. It's running less than $6. I do think it has further to go, and I don't think that there is any reason to interpret the back of the curve prices not coming up as being bearish. The fact that the term structure is steepening is a sign of increasing bullishness in terms of market participants and outlook. I expect the steepness of the term structure to continue to steepen as we continue to move on into next year. And I think it potentially gets dramatically steeper between 2022 and 2024 if a number of things all happen to line up the way I think they might. It's too early to call that one yet, but as far as right now, I do think it gets steeper from here, and I don't think we're done yet.
What do you think would be the circumstances for us to see the entire term structure level rise, like a tide coming in, where we see $60 or something at the belly of the curve?
Well, Patrick, I can't help but wonder why you're asking that question or what insight you think is revealed by answering that question. I mean, unless you actually want to make plans to take delivery of crude oil yourself 10 years from now and you want to lock in your price right now, we're looking at this in terms of what does it mean for the front month. And I don't think that what happens in those back month prices really tells you very much. The back month prices really are a product of market expectations that lead to certain amounts of backwardation or contango, and then they're all anchored to the front of the curve where the price discovery occurs on the front month contract. So, Patrick, as far as what happens to the price of crude oil in 2027, it matters from the perspective of analyzing the shape of the term structure, but I don't think that absolute number is meaningful in the way that you're alluding to. But, Patrick, going back to page 7, I want to ask your opinion because you are the resident technician. Look at this chart. Obviously, something big changed in November. That was the beginning of an epic rally that took us through the beginning of March. Then we consolidated for a couple of months, and now we're breaking out. How do you think about this chart as a technician in terms of trying to choose a target for where the market might be headed? I mentioned a simple measured move technique that I've applied. You're the better technician. What techniques would you apply? How would you set price targets for where this rally might ultimately top out?
Well, I think the shorter target lies in the 70-72, but that's like something that could be achieved within a week on the upside. But if this is a legitimate bull breakout on that, then definitely the targets all lie in that kind of $80 to $90 range on the upside. I think the most important thing when you get a breakout like this is to actually see whether the bulls can hold it. And what often is a bearish sign is if we saw the entire breakout given back in its entirety and more, and we go back to trading, down into the mid 60s. If we saw that, then that would put a kind of a big damper on this breakout. So really, I think going into next week, you want to see whether or not the bulls keep the price action bullishly advancing. Lots of confirmation from other markets. I want to see the energy stocks also starting to participate with more velocity. And if we see that kind of price action, then your targets up into toward 90 are all achievable if they can keep building the momentum on us.
Let's move on to page 10 and lumber futures. Boy, what an interesting chart. We've kind of got looks like a blow-off top and then an echo blow-off top.
Right, and so one of the key things that I was watching, obviously we came in with a pretty significant short-term parabolic blow-off on the upside back at the start of May, and we saw the lumber futures give back close to $500 off their peak highs on the downside. But when we got that reversal approaching 1500, that was actually a very important moment to see whether or not the bulls had enough gas in the tank to make another run towards all-time highs. And the fact that we failed and have more or less been very distributive in the price action, there's an increasing chance that we have seen peak lumber on this intermediate high level. And it's entirely possible that we're going to see it work its way down toward 1,000 on the downside. And it's not a crazy thought to go back to 1,000, because if you go back and look at several years, even a decade of price action on lumber, we have not seen 1,000 until this breakout. And so for us to actually consolidate down to and stay above 1,000 would still, in the much, much bigger picture, be bullish for lumber. But it's simply at this stage that short-term high is now leading to this distribution cycle. And that's where on page 11 we have that lumber term structure. And again, we're in a similar situation in terms of backwardation, the way you were describing it in the oil market as well, which is that front month lumber contract is trading up there in the 1,300 plus level. But almost all of the contracts in November and farther out are all trading at 1,000 or less. And it really kind of goes to show that this entire lumber surge may very much have been, dare I say the word, transitory in terms of short-term demand versus the supply that was available. And maybe we'll see a bit more of a normalization in lumber prices in the next half a year or so.
Patrick, what do you make of the very sharp turn down in gold? And of course, it was commensurate with a turn up in the dollar index. Some people, I'm sure, are saying that's it. The gold market's going to crash from here. I don't think so. What do you think?
Well, I think that gold, after that really solid 2-month run, needed to have a point where the rally was checked and just to wash out the weak hands that were chasing this market higher. But what's interesting is that much of the entire consolidation of gold that happened over the 6 months prior to the breakout saw the price action trading below all of its moving averages. And so what's interesting is that this correction lines up where a 50% retracement comes for a test right into the moving averages and its December lows. And so I think that a pullback in gold towards 1800 would be actually quite natural, but the real tell will be whether the bulls buy the dip and hold the line in those support lines. If we see another $50 on the downside of gold and the buy and dip traders solidly defend it and reverse it off those levels, that actually would only reinforce the fact that gold has shifted into a new bull phase.
Patrick, I just want to clarify what you said about the $1,800 level as the 200-day moving average. My chart has the 200-day moving average around 1850 and has the 100-day moving average at 1800. Are we talking about the same 200-day moving average?
Right. Thanks for bringing that up because we have to clarify that. You're looking at the simple moving averages, which is actually quite commonly used. It's not wrong, but in this particular case, I have the 50 and the 200-day exponential moving averages, which are just trading at a different level. And so it is, I guess, important to observe where that simple moving average is in there. But the support line that I was talking about, where the 50% retracement, Fibonacci retracement level is all around that 1800 level.
Well, that makes perfect sense. And of course, listeners, for any of you who want to be on top of this stuff and know the difference between an exponential moving average and a simple one, check out page 13 of the chart deck, where you can sign up for a free trial of Patrick's service, Big Picture Trading, and learn all about it with Patrick's chart decks every single day of the week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.